Not all dividend income is built to last, especially when the market goes into panic mode. Some stocks cut payouts at the worst possible time, leaving your cash flow exposed just when you need it most. In this video, we're diving into proven strategies to safeguard your dividend income before the next crash hits. You'll learn how to stress test your portfolio, pick companies built for consistency, and create a dividend plan that keeps paying, even when the market doesn't. This isn't about reacting to chaos. It's about being ready for it, so your income stays steady no matter what the headlines say. Part 1. The impact of market crashes on dividend income. What happens to your dividends when the market crashes? Let's be real. When panic hits Wall Street, your income stream might not be as safe as you think. Companies under pressure start cutting costs. And guess what often ends up on the chopping block? Dividends. But not all dividend actions are the same. Some companies cut their dividends. That means you still get paid, but a lot less. Others go a step further and suspend payouts entirely. Zero. Nothing. That can send a wave of fear through income-focused investors. Let us look at history to understand how bad it can get. Back in 2008, during the financial meltdown, massive banks like Citigroup and Bank of America slashed their dividends to pennies or suspended them altogether. The financial sector got crushed, and investors who depended on those checks were left scrambling. Then came 2020. The COVID-19 pandemic triggered another tidal wave of dividend cuts. Cruise giant Carnival? Gone. Boeing? Gone. Equinor, one of the biggest oil players in Europe, slashed their dividend by more than half. The common thread? These were companies hit hard by shutdowns, debt burdens, or collapsing demand. And their dividends paid the price. So if you are banking on dividends to keep your income stable during tough times, you need to be prepared. Coming up next, we will show you how to identify companies that can actually hold the line, even when the market is falling apart. Part 2. Financial health, the foundation for dividend safety. If you want your dividends to survive the next crash, then forget stock tips. What you really need is a balance sheet. When companies get hit by economic turmoil, only the strong survive. And in the world of dividends, strong means financially bulletproof. Let us break it down. First, look at the payout ratio. If a company is paying out more than 70% of its earnings as dividends, that is a red flag. It means there is barely any cushion if profits drop. You want that number low. Under 60% is even better. That shows they have room to breathe. Second, free cash flow. This is not the same as earnings. It is the actual cash the company has after covering its bills and expenses. If they do not have real cash left over, your dividend is not safe. Period. Then there is debt. A company drowning in debt might be able to fake it during good times, but during a downturn, they will cut the dividend to stay alive. Look for a low debt-to-equity ratio. It means they are not borrowing too much to pay shareholders. Also, watch the interest coverage ratio. This tells you if the company can even afford to pay its loans. If they are barely covering interest, how are they going to pay you? Now zoom out, check the balance sheet. Companies with low net debt and plenty of equity are built like tanks. High liquidity ratios? That means they can handle short-term shocks without panicking. Financial strength is not just about surviving. It is about keeping your income flowing when others hit pause. Coming up next, we are diving into a strategy that adds even more protection. Diversifying into recession-resistant sectors that can keep paying you no matter what the market does. Part 3. Sector diversification. Protecting income by spreading risk. It does not matter how strong your dividend stock is. If you are too concentrated in the wrong sector, a crash can still wipe out your income. That is why sector diversification is not just smart. It is essential. Let us start with the safe zones. These are sectors that keep paying, even when the world is falling apart. First, consumer staples. People still buy toothpaste, detergent, and groceries no matter what. Companies like Procter & Gamble or Coca-Cola barely flinch during recessions. Their dividends? Rock solid. Next up, utilities. Electricity, water, gas. You cannot skip the bill even in hard times. These companies often operate in regulated environments and deliver incredibly steady payouts. Then there is healthcare. Whether the economy is booming or busted, people still need prescriptions, doctor visits, and surgeries. Big pharma and medical device firms? They keep making money, which means, you guessed it, reliable dividends. But here is where things get dangerous. Sectors like consumer discretionary, industrials, and financials? High risk during downturns. Think about it. When the economy tanks, who is buying new cars or booking cruises? Companies in these sectors often slash dividends just to survive. Industrials slow down when construction and manufacturing stall. Financials get hit with loan defaults and credit freezes. These are not places to rely on for stable income in a crisis. So how do you protect yourself? Spread your bets. Diversify across sectors with low correlation to the broader economy. Make sure your portfolio is not leaning too heavily on any one risky group. Because in a market crash, it is not just about what you own. It is about where those companies earn their money. Next up, we will go beyond stocks and look at powerful dividend-focused funds that can automatically screen for safety, so you don't have to. Part 4. Valuation matters. Buying quality at a reasonable price. Chasing high dividend yields can be a dangerous game. A yield that seems too good to be true often is. Why? Because high yields might be the result of a falling stock price. And that falling price? It is often a sign that something is seriously wrong under the hood. So what should you do? Look beyond the yield. Focus on valuation. The price-to-earnings (PE) ratio is your first checkpoint. A lower PE compared to industry peers can indicate the stock is undervalued. Just make sure the earnings are real and sustainable. Then there is the price-to-book (PB) ratio. If it is under 1, the market might be underpricing the company's assets. That is where hidden value can lie. Combining these metrics helps you spot companies that are not just paying dividends, but are built to keep paying them, because owning an overvalued stock with a juicy yield can backfire fast when the economy turns. True safety lies in paying a fair price for high-quality businesses. Get that right, and you do not just protect your dividends, you grow them. Part 5. Defensive funds and ETFs that can help shield your dividends. When markets crash, even the strongest dividend stocks can falter. But what if you could automate your defense? Enter dividend-focused ETFs. Funds designed to keep your income flowing, even when the market tanks. These are not just any funds. They are built with strict quality screens, selecting companies with strong balance sheets, consistent earnings, and a history of reliable dividends. Take the Schwab U.S. Dividend Equity ETF, SCHD. It focuses on high-quality U.S. companies with sustainable dividends. Think of it as a curated list of dividend stalwarts. Then, there is the ProShares S&P 500 Dividend Aristocrats ETF, NOBL. It tracks companies that have increased their dividends for at least 25 consecutive years. That kind of consistency is rare and valuable during downturns. For those seeking low volatility, the Invesco S&P 500 Low Volatility ETF, SPLV, selects the 100 least volatile stocks in the S&P 500. Stability is its game, and if you are looking for high yield with a defensive tilt, consider the Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. It combines high dividend yields with low volatility aiming to provide income without excessive risk. These ETFs offer diversification, professional management, and a focus on quality, all crucial when navigating turbulent markets. But remember, while ETFs can provide a buffer, they are not foolproof. Part 6. Real-life case study. Dividend survival in the 2008 crash or 2020 pandemic. When the market crashes, do your dividends vanish? Let us dive into history to find out. 2008 financial crisis. The 2008 financial meltdown saw many companies slashing or suspending dividends. Citigroup, for instance, reduced its dividend payouts significantly during the crisis. But not all companies followed suit. Some maintained their dividend payments, showcasing resilience amidst economic turmoil. 2020 COVID-19 pandemic. Fast forward to 2020. The pandemic led to unprecedented economic disruptions. According to Janus Henderson Investors, global dividend payouts fell by 12.2% in 2020, amounting to a reduction of $220 billion. Yet, two-thirds of companies either maintained or increased their dividends, highlighting the importance of selecting robust dividend-paying stocks. If you've made it this far, I've got a free resource to help you protect your income when the market gets rocky. It's called the Dividend Defense Checklist, a simple, powerful guide that shows you exactly how to safeguard your dividends before, during, and after a crash. It includes the key warning signs to watch for, portfolio protection moves, and a printable crisis-proof tracker. Just comment "Defense" on this video. Once we hit 50 comments, I'll drop the link for everyone to download. If you're serious about protecting your passive income, don't stop here. In the next video, we'll break down exactly how to safeguard your dividends when the market takes a dive. Click through and learn the strategies that keep your income flowing, rain or shine.